Hello everyone and warm greetings to all. Today we are in quite interesting times, especially in the fixed income landscape, wherein globally central banks are becoming more region specific and are taking a very data centric approach to tackle their own economies. So this whole, change and evolution is making the whole fixed income landscape very appealing for the investors and market participants alike. To shed more light on it, to discuss more on the same, today we have with us Mr. Mahendra Jaju, Chief Investment Officer, Fixed Income at Mirae Asset Mutual Fund. Welcome, Mr. Jaju.
Thank you, Kanya, for inviting me today.
So without further ado, let's dive more into it in the fixed income landscape and our upcoming new fund offer, which is Mirae Asset Income Plus Arbitrage Active FOF. So, sir, my first and foremost question to you is that how is this category of income plus arbitrage active fund of fund is different from, say, debt mutual funds or arbitrage mutual funds?
So this fund category is different in two very unique ways compared to, say, the existing debt funds that you have or the arbitrage fund. So first is that we know that the biggest put-off for the investors in debt fund was the removal of the tax benefit. And this category is now able to bring back the long-term capital gain tax advantage to the investors in the primarily the debt category. So let me just explain to you how it works. This is a other category FOF where the exposure to the arbitrage category will be at least 35% at all times and the exposure to debt will be 64% or less. That would mean that under the revised taxation structure, this fund will be eligible for a long-term capital gain tax treatment of 12.5% if the investment is held for 2 years or more. So this addresses one of the biggest disappointment factor for the debt investors over the last 3 years. The second is, as we have seen in the last couple of years, the investment outlook in the fixed income changes very fast. As you mentioned in your opening remarks, that most of the central banks are very, very data driven and data is changing very fast. So very quickly from expectation of a rate cut, the sentiment changes to one of a despondency. And the investors have found it a little bit complicated to deal with that. And that is one reason maybe people are opting for simpler options like the bank fixed deposits and so on. So this fund again will be actively managed. After the categorization of the debt funds, I think investors have been missing the dynamic allocation strategy. So active allocation between different categories of the debt space, like say short duration or ultra short term or long duration, with the active management that will happen. And then, over the last few years, arbitrage has come up as a very strong opportunity because of the better spreads that the arbitrage category is able to offer. And this fund will then combine and top up the debt returns with the arbitrage returns. So I think this is a unique combination, new category, as you said, which is available for the first time to the investors who have been looking at the debt mutual funds. And therefore, I think it is an excellent product from my perspective and it should do very well.
So now that we know about the category, so moving now on to, Mirae Asset Income Plus Arbitrage Active Fund of Fund. So what criteria would you choose to, or you would have to allocate between debt asset class and arbitrage asset class?
So we have a full range of the debt mutual funds right now that we are managing. And there is a very well-defined process by which we come to the conclusion on the outlook for the fixed income market. We continuously analyze different factors that affect the debt market, be it the RBI's monetary policy stance, inflation outlook, credit outlook, growth outlook, liquidity situation. So we keep on analyzing the factors which affect the outlook for the fixed income market. And on that basis, we will take a call on how much to allocate to debt and into which sub-segments of debt, whether, say, for example, to the liquid category, or for that matter to the long duration category. And in this product, we will have one more dimension, that is, once we have arrived at the conclusion on where to invest in debt, we will then compare that with the outlook for the arbitrage opportunity. And therefore, at the first layer, we will analyze the debt outlook, and in the second layer, we will then compare that with the expected opportunity piece on the arbitrage side. And on that basis, we will then, do the allocation. It's pretty straightforward. If the arbitrage is expected to give better return than debt, then higher allocation will go to arbitrage and vice versa.
Okay, sure. So now coming a little deeper into the fund, how will the investment framework aid in selecting, different underlying schemes? Say particularly, like you said, we have various debt mutual fund schemes available. So how that will help us, or how would you select those underlying schemes? How the framework would help you?
So as I mentioned that we have an established framework for arriving at an interest rate outlook. And as we have seen last week itself, that even though the RBI cut interest rates, the rate cuts were upfronted, and thereafter the long-term bond yields have gone up, and there has been a meaningful change in the outlook in terms of the fixed income. And broadly, the market consensus that is now emerging is to shift from a capital gain oriented or duration oriented strategy to an accrual strategy, because most of the rate cuts are behind us and the liquidity is is in a bit of an overhang situation. So accrual is likely to do better. So similarly for this fund also, we will continuously keep on evaluating. There will be a periodic rebalancing to ensure that the allocations are within the offer document limits and in line with our expected returns outcome. If we, for example, are positive on the long end of the curve, then we will be having higher allocation to the long duration fund, or for that matter, say corporate bond fund. If we are within the duration space, also very positive about the corporate bond spreads. Vice versa, if we feel that the duration is not likely to outperform, then we shall shift the allocation more to the liquid fund or ultra short or one of those categories. Now, while we do the switches, we have to be also cognizant of the cost involved in transactions, both in terms of the opportunity and also in terms of the transaction cost. And then we have to compare it with the arbitrage space. So let's say, for example, at this point, we are largely coming around to the view, even though it is some time that we will take to have a more definitive outlook, that maybe it is time to switch to the accrual oriented strategy. And within that, we are looking at the money market space because the money market curve is still very steep. Now, therefore, we have to look at the arbitrage opportunity versus the money market opportunity. And then in case of arbitrage, the spreads can change from month to month, whereas for money market, we have a little longer outlook. So we have to therefore get a more confident outlook on how long that arbitrage spread can continue, whether the futures are trading at a decent premium which compensates us for the money market returns or not. And that will involve multiple iterations and scenario analysis, little bit of stress test analysis as to what is my break-even point or inflection point for making a wholesale switch. So we will keep all these factors. And as we know that in markets, future is unpredictable and uncertain. So we have to take it as it comes. But that's broadly the thought process. That's broadly the process as to how it will work.
Right. So as it is a fund of fund, to add the active part to it, you'll be, be very dynamic with the allocation in the underlying schemes, particularly on the debt side, wherein you have options as per your framework.
So our dynamism will be a function of the market dynamism. Right. So let's say if the market is very flat, there isn't much volatility in the market, and there are measures to gauge the volatility in the market. If the markets are flat and very range bound, then our action will also be that much limited. So our action will depend on the market action. And if markets are very volatile, if markets give a very clear signal in one segment of the fixed income or on the arbitrage space. So we are active, but our action is driven by what the market action is. So to that extent, what I'm trying to say is that we are not just going to be hyperactive just because it's an active fund. The purpose of the fund is to try and allocate to the best possible option within the area that the fund can operate, and it will be a response to how the market signals.
Understood. So you mentioned that the allocation will be based on the market signals, and you also somewhere mentioned on the rebalancing side. So my next question to you would be, what could be the rebalancing, say, triggers or opportunities that you would see, on a periodical basis in this fund?
So I would classify the rebalancing in two parts. One is a periodic rebalancing that we will do to ensure that we are in line with the overall allocation limits and within the accepted risk. For example, the fund has a PRC framework, so we have to comply with that. And then there are riskometers which tell us how the fund's risk composition is changing. So we will monitor that as we monitor for any other fund. And then the trigger for the rebalancing will be an external market event. So as I said, our fixed income framework is broadly based on three scenarios: market neutral, positive or negative. So accordingly, we will have to do the allocation. So if our outlook changes, say for example from neutral to positive, then we will shift the gear from accrual orientation to the duration orientation. So the signals have to come from the market. The trigger for a major rebalancing will be a major change in our outlook for the market. For example, if we get the confidence that arbitrage will continue to outperform the short duration or the basically shorter end of the curve, then we will continue to be a little overweight in the arbitrage category. So as I said repeatedly, this is an active fund, but the action is dependent on the market action. So our rebalancing will be dependent on how many times the market rebalances its outlook.
Right.
So just to add that there is no prefixed formula about it. The dynamic or active management means that when you get a new signal, you decide whether any action is warranted or not. And therefore, to that extent, we are dependent on how the market gives us a signal.
Right. So now before we sum up this conversation, I would, ask you to, in your understanding, what's the outlook for this evolving fixed income landscape, particularly, how central banks are becoming more region specific, more data driven. What's your take on the same?
So clearly there has been a huge divergence between the monetary policy followed by different central banks. So for example, on the one hand, we are seeing Fed now on a pause mode, and then Fed becoming increasingly data dependent, whereas the European Central Bank has cut rates, I think 8 times in a row. And then we have seen RBI affronting all the rate cuts, which is a very bold and aggressive move, as people say. So I think Fed is responding to the uncertainty in the US market. European Central Bank is responding to the low inflation and the need to support growth in the Eurozone, whereas RBI is riding on the strong macro fundamentals of India. This is the first time since the inflation targeting regime has started that the full year projection is below 4%. So therefore, RBI has the space to be a little more aggressive and affront the rate cuts. And RBI seems to be clearly conveying the message that, look, we need the support to growth now. And therefore, let's put everything upfront. However, that also means that the scope for the rate cuts in future is therefore that much less. And therefore, we have had a very beautiful, situation in fixed income market for last 2 years. The bond funds have done very well, but then we have to evaluate whether that kind of a run for the bond funds will continue, or now is it time for the switch to an accrual orientation. Now, the credit policy was announced on 6 June, which was just a couple of days back. and market is still evolving its response, because there are many analysts who believe that irrespective of what RBI says, there is still going to be space for one more rate cut in December. And we have seen that, after an immediate excitement or disappointment after a major policy announcement, the market takes a little more time to find, analyze the nuances, and then market takes a directional view in 2 weeks or 3 weeks time. So we are also in the process of ascertaining whether there is a time for a definitive switch or we need to be a little more balanced. And once we get that sense, then we will make the changes. But my sense is that the major part of the duration based rally is over, and it is time to shift at the far end of the money market curve, which is where you have the money market fund at this point, maybe some allocation to short duration fund. So this is an evolving market. Dynamics changes very frequently. Therefore, there is no way that we can give a definite answer. As I said repeatedly, this is an active fund, but the action is based on what the market does. So we'll keep watching. But I am beginning to come to the conclusion that it's time to scale down the duration exposure and look at the far end of the money market curve, which is 9 to 12 month category. And that's where I think most of the action would be possibly for rest of 2025.
Right. So if I have to just ask you one last question, that in this backdrop of fixed income market that you explained, today the fund is going for NFO, but had it been supposedly been active today, what would be the underlying schemes you would be looking at right now? We are, just few days after the RBI policy, and in just starting days of June, 2 weeks have gone. So what would it look like if the fund would have been active right now? What would the underlying schemes look
so
like?
Let me avoid the theoretical hypothetical situation, what if the fund was there, but let me deal with what is a realistic situation. So let's say NFO closes in a couple of weeks time, and then we have to build a fresh portfolio. And based on what we have discussed now, based on what we think is now the likely market situation, I think the exposure to arbitrage will be somewhere in the 40 to 50% bracket. The exposure to money market and short duration combined will be somewhere between 30 to 35%. We will still possibly have 10 to 15% exposure in the long duration category, because we also now have the advantage of the market correction post the policy. So that segment is now looking fairly valued. So I think broadly that is where I am on this moment. But then obviously there are a couple of weeks time and things can change. But that's where I think is the most likely start.
Right. So thank you so much, Mr. Jaju, on taking us through the, fixed income market outlook and, shedding light on what this product and category is all about. So thank you, viewers, for being with us, for joining us today. The new fund offer of Mirae Asset Income Plus Arbitrage Active Fund of Fund starts from 16th of June 2025 and ends on 30th of June 2025. So thank you so much, Mr. Jaju, for taking us through all the
Thank you, Tanya. Thank you for going through the different aspects of the fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.